I'm Keith McCullough, and welcome to The Pitch. McGough just said, what the hell is up with this music? All right, we're not doing music. We're going to do 6 stocks with 6 analysts in 60 minutes. It's going to be tight. Each analyst gets 60 minutes to pitch, and then I get asked, I'll make some comments on trade trend levels and things you care about, and maybe have some pseudo-intelligent questions. So lead off, man. I know you got your energy drink going, and you got something new here.
I'm hyped up. I'm ready to go. How can I not start with just honoring Todd on his birthday?
It's his birthday, that's right.
It's his birthday today. So one of the greats of all time. But Todd loved the pitch. He was great at it, and I hope to be as good as him. But I'm here to pitch you a long.
I know.
This is the first time, Keith, in 18 months that I have pitched a long on the pitch. I've been like Mr. Short, and the long is Beyond, B-Y-O-N. This is a name that we just went long last night, which is breaking with my process. Those who know me and my research and that of my team, we usually add new ideas over the weekend as we go through our Sunday grind, and we restack our best ideas based in part on signal strength and what the pods are telling me. But if you don't know Beyond, which you might not, it's the former Overstock.com. OSTK is now BYON. What this company did is it bought Bed Bath & Beyond's IP and customer list out of bankruptcy, and is now going after that business. You have a new CEO, Marcus Lemonis, who is ruthless. This guy is just absolutely ruthless. He is a man with a plan. He claims to have cracked the code on Wayfair, which means that he intends to put Wayfair out of business. That company just put up a miserable quarter this morning. The stock is squeezing up. I think it's a short, because if I'm right that Beyond is a tail triple, then Wayfair is going to $10, and Wayfair is now trading at 54. So the thing I really like about Beyond is what the company did in the quarter it just reported is it really stepped on the accelerator on discounts in order to drive new customer engagement and drive new customers to its platform. New customers grew by 29%. So you had a 650 basis point drawdown in gross margins. I generally don't like that. The thing I do like is the pods. And if you are new to our process and new to Hedgeye, the pods are critical to how we analyze companies. Pod 1 is revenue growth. Pod 2 is cash flow. And pod 3 is the balance sheet. And here you have pod 1 accelerating from here down in this last quarter and going to a plus 25 rate by the end of the fourth quarter of 2024. Gross margin was just down very materially. Again, down 650 basis points. That's accelerating. It'll still be down in the upcoming 1 or 2 quarters, but down to a lesser extent. That's what we call an acceleration on a rate of change basis, which I like. So, and then on top of that, on top of the gross margin, you have SG&A, as this has been a fat company for so long, and now you have this new CEO who's cutting costs left and right, just sold the big headquarter building. I usually don't like when retailers cut costs. I like when they invest back in their business. But this guy's got plenty to play with here on the cost-cutting side. So your revenue going up, your gross margin's getting better on the margin, and SG&A flat to down is just an explosion in your EBIT dollars. And that flows right through to cash flow, your operating cash flow. And then this company is cutting its CapEx in half. So there's pod 3. Pod 3 looks really good. Your operating cash flow is going to flow through to your free cash flow at a far greater rate than it has historically. So, Keith, the whole point here is that it's very rare for me to find a situation where any company where all 3 pods are going in the right place at the right time. Usually I've got to sacrifice one and hinge on the other 2, but now I've got all 3. And pod 3 stories, as you know, turn into really good pod 1 stories because the company generates all this cash flow, can reinvest back in its business, buy back stocks, start paying a dividend, do all these things that people pay for. But here we've got it all, and we've got it at the same time we're going through a macro pivot, which leads me to your signal, which I would love your insight on.
The trend on this, so this is what we call a bearish to bullish trend reversal. That's a lot, but that just means you're going from bearish to bullish trend. Okay, and 2301 is that level. What's interesting about this, Brian, too, is that A, that's recent. B, like when he says triple, people are like, it's just McGough. Well, first of all, when he calls doubles and triples, they happen. So, but second of all, more importantly, I mean, this stock was at 110 before. So, I mean, if you pull, and those are the really good ones, where you go from economic cycle peak, 100 to 110 bucks a share, whatever, collapse, small caps collapse. They were great shorts as a factor exposure, to down on the rocks. And this dude who sounds like he's from the Greek Revolution.
Limonis.
Well, I have a question for. I mean, I was just doing some work while you were talking, just some screening work. He was buying stock like when he was a director between 14 and 16 bucks a share between October and November. When did he get named CEO?
So he is not CEO. He's executive chairman. He's actually CEO of Camping World.
Oh, really?
Okay.
But
he's executive chair of the company. They just named a new CEO 2 days ago. So this person is brand new. The thing I really like is this guy loves his stock. And
he just bought it on his own. I mean, it's up 50% from where he bought it.
And what I love is the incentives. So if you look at it, the stock's now at 28 bucks. He's granted 500,000 options if it trades at $45 for 20 days in a row. He's granted 750,000 options if it trades over $50 for 20 days in a row, and 1 million options if it trades over 60.
Wow.
So this guy is incentivized even better than Gary Friedman is, or was at our age, which is when he turned it from a $28 stock to a $300 stock. So this name is one you really got to keep an eye on. It is on our long bias list. We just added it to our list. That's our process. We stick with our process and don't deviate from that. But if this is not a best idea long in very short order, even if it's at a higher price, I don't care if I give away a couple of bucks on the upside. I'm perfectly okay with that.
Yeah, I mean, when we go from best idea, from bench idea to best idea, it's just semantics, right? I mean, we're just trying to. You have to do all the work. We have to get the models all done up. But you got a good one here. This fits all of the quad factoring through that we're looking for, and the signal, of course. So well done.
Thank you.
All right, Brian McGough leads off with a juicy one. He always brings the juice, though, right? I mean, and thank you for that on Todd Jordan, remembering him, and again saluting him on his birthday. Rest in peace, buddy. Jay on the Zoom. I'm very happy you're on the Zoom, as I said on the call this morning, because when you stand next to me, people can see my percentage body fat as a percentage relative to yours.
I'll have to sit here and work on adding some more body fat. Instead, I'm going to add along to the pitch another one here, which is Rent-A-Kill, which is notable because it bought the Terminix pest control business. So this is a company that is, you can see on the first slide, 80%-ish of the operating profit just comes from pest control. They are historically the world's largest pest control company based out of Europe, and they have entered the North American market quite aggressively, most notably buying Terminix. So on slide 10, this is a stock that very much kind of blew up, right? And that's in part because the Terminix business has faced a lot of headwinds, some management turmoil. I mean, it was owned by ServiceMaster, which had an odd corporate culture, sold to private equity, was kind of bled out and came out public without the best structure. And, Rent-A-Kill, I think, is a great owner for this asset, right? It's the best brand within pest control. And they're a great operator. And what really matters in these kinds of businesses is controlling the key metrics, things like churn, employee retention, just getting the route density right. The blocking and tackling in business services is what matters. And this is a good owner to actually execute on that. And I think this is the kind of stock that can give you 40% upside without a ton of risk. And one of the reasons for that is just on the next slide, which you can see that this industry just consolidated a lot. Right, so this was more competitive 5 years ago, and now you have two players that are really dominating, the market with, almost 2/3 share between the big three. It's typically a growthier industry in real terms. If you look at slide 12, you can just, in general, it grows. There's all kinds of reasons for that. Mostly people don't like pests. They don't want bed bugs. They don't want mice. They don't want cockroaches. They don't want termites. But one of the things that's interesting is that Rollins has grown, which is a competitor that owns the Orkin franchise, the other big competitor within the space, has grown much better than Terminix and Rentokil in North America, right? So what's interesting is that little gap in the organic growth rate is 30 turns of multiple points in the equity market. Now, I think Rollins is overvalued and has some issues. We've had Rollins at times on the short side even we had Rollins specifically into their accounting issues and departure of a CFO, but we don't currently have it. And I think that is an interesting spread that Terminix is well positioned to close. And one of the problems they've had is they've had more churn in their customer base, right? So their margins have come down over particularly that PE to public company period. And historically, Terminix was more profitable than Rollins, right? Historically, it was actually a better business, and Rollins has, I think, done a good job executing on raising prices and expanded margins. And I think there's a nice runway there for Terminix to close that gap. We can see that on the next slide, many of the sort of retention, KPIs, things like that, have already started to improve. So I think there's still a lot of room there. And we run a survey on 16, and Terminix still has the best brand. 40% of respondents still prefer Terminix over other brands, including their local brands. It's one of the few national brands. And what's also interesting is people responded in that survey that they didn't like price. They don't want to pay more for pest control. But if we look at the samples of the survey that we have historically, they're actually willing to pay a lot more now. I mean, they're both aware of inflation and apparently have rebased their expectations to accept it. So I think there's still a lot of room for Terminix just to take some price in the coming years. And then when we look at the actual underlying drivers of demand, one of the problems we have is that pests come back. Pests are sort of a perpetual, even going back to like ancient Egypt or whatever, there were locusts and pests everywhere. So we see bed bugs complaints ticking up in New York, which is very unfortunate because I am currently in New York. We see hot weather, mostly in December into January. It's cooled off a bit in February, but for the most part, on the next slide, you'll see, just in general, the weather's been hotter and there hasn't been a lot of drought. It's been wetter. So wet, hot weather tends to drive activity, particularly in the Southeast, which is where a lot of pest control revenue comes from. And, just sort of a secular driver over this period has been the aging of the housing stock. Older houses simply get more cockroaches, rodents, and other vermin because they have, I guess, more holes or places to enter. They're less, some of the protections wear off. And you may or may not believe in global warming, but clearly the peak temperatures over time, which are very easy to measure, have gone up over time. So we are seeing sort of pests migrate north and expanding that pest control window for these companies. A lot of investors like that kind of secular theme. And pest control is very much an obvious winner amid hotter temperatures further north and hotter low temperatures further, in the winter. And just in general, Rentokil has never been cheaper, at least in sort of the period of time that matters in the last 5-ish years. Whether on any metrics, I think it's pretty cheap. It's got its operating metrics turning. And I think this really, in this context, de-risks it, where you have a lot less, it kind of already has blown up, right? Like all they have to do is trip over expectations, be a little bit more like Rollins, and you get a good deal of upside. So that is it for Rentokil.
I like it. In fact, when you look at, there's so many people that want to make this call or have been making this call, I shouldn't say, and have had a position. Actually, a lot of people on TV make calls that don't have a position. Let's be clear on that on Old Wall TV, but that's why CNBC is the longest running comedy out there on cable. But the fact of the matter is that we have a lot of small and mid-cap stocks that have been complete disasters. There's an entire cemetery of these things, and you and McGough start with two names that got cut in half. McGough's the one that he came up with, got cut in half multiple times. But this thing went from 43 at the cycle peak. A lot of small caps peaked at the cycle peak. Shocking, right? I mean, so November 2021, it was $43. It went to $23. Now it's back to bullish trend almost. It's like within 50 cents, but it's already picked up the immediate-term trade signal bullish, and it's right in that sweet spot of market cap. It's got more cap. It's got $13 billion in cap. Is that you look up the holders? It's got there's only Janus is the only institutional holder that has more than like 1.5% position. Is this a name that when you talk to our institutional clients that they even care yet?
Yeah, I mean it's European listed. It has the ADR that's trades,
Right.
but I think that there are times, particularly if you look at your quad progression for 24, it
Yes.
makes me feel a little bit more comfortable with it. But still the profit is dominantly from North America. It is a name I think that is not as well known. I think people don't know the origin of even the name Rent-A-Kill. It sounds stupid. It sounds like you rent something that kills you, but it turns out it was a merger of a Rent-A-Kill initial and whatever. It's not finally that important, but it is a little bit under the radar, unknown, but in business services, a lot of the best franchises kind of look like this. They just do something very basic, very well every single day. And that's how you build a Cintas, that's how you build an Aramark, that's how you build, we had good luck with Brinks, right? Even though that has probably executed less well in the middle of the last decade. They're getting their act back together, and I think this is in that category.
Yeah, I mean, as soon as you went with it, I looked up Terminex on ChatGPT, which, by the way, may or may not be true. The things you get back on that thing, of course. But rodents, insects, and termites. I mean, I get it. I don't care what the name is. I know what it does. And by the way, slide 35, what Jay just said is critical. Looking for small cap European longs is way outside of consensus. But again, we have the European economy coming out of a recession finally after calling that accurately. And I expect to find more European ideas. So nice job with that, Jay. Appreciate it. All right, live. I get to go with you.
All right.
How you doing? Tom Tobin, for those of you that don't know.
Easy to pick out of a crowd. So 10x on the short side. The problem with healthcare, I feel like I bore people because this stuff kind of comes around and sticks around for a really long time and keeps giving, and I think 10x is one of those stories. Essentially, they're sequestered, or their opportunity is really within a very small, niche academic research question that they're trying to answer with a new tool, and sometimes these tools have escape velocity and they become diagnostic kits, and this is not one of those things. They solved a really clever problem for research scientists. Research scientists are addicted to novelty. They use novelty to get papers published, to get more grant money, to hire more techs, to produce more research, to get more grants, and so on and so forth. And when the novelty wears out, things slow. And they've been in a super cycle. So the first thing you start with 10x, at least where I've been starting with, is the bearish signal. So if you look back at the quad factor scoring that I've been doing, looking at, how does the factor exposure for 10x compared across all prior quads that we're in right now, it's very, very bearish. So I don't have to really worry about upside, and I know I'll get punished. Essentially, the stock will get punished if things go poorly. They've been in a super cycle of NIH funding on top of a growth rate that's been very positive for their technology in terms of the adoption. So NIH has had a very good 2023 in terms of funding. They've had a very good COVID. So if you go to the next slide, you can see where NIH spending has been. So that last black line, NIH has been up and to the right. But on the next slide, you can see on the forward basis, it's starting to look more negative in terms of the budget outlays, et cetera, sort of political criticism, et cetera. Next slide is, so single cell sequencing sounds super complicated, but really it's a way to look very specifically inside a cell, what genes are being expressed, where they're being expressed inside the cell, across lots and lots and lots of different cells at the same time. Genomics, Illumina, Affymetrix, all these old names, they were in, if you look at the top line there, the idea of genomic research has been around for a while, but it's topping out. So that's the term that means genomic means that these grants are going to spend money on these tools and equipment, topping out at around 20%. The darker line is single cell, that's come up, right? That's been growing as a percentage of that total. But if you look at the next slide, the blue line here is the active. The number of grants that are active in looking at a single cell type experiment have topped out and are rolling over. That coincides really nicely on the next slide with where estimates have been with top line. So those all topped out around the same time. So the draw on the dollars from NIH. Next slide, EV to sales. Guess what? When things slow, the multiple collapses. So this had been greatest thing since sliced bread, but it had a EV to sales multiple in the in the 30s on an NTM basis. as those estimates were thought to be, oh, this is going to be $1 billion in sales someday. Right now we're looking at 2024 in the 670 to 690 range. Street was at 710. It's been coming down here now for a couple of years. I think it's going to go towards 600 for the year. I mean, I don't. It's not that complicated. If you look on the next slide, how the math works is essentially I'm counting grants. I take their consumable sales divided by the number of grants. I can guess. I know how many grants are going to expire this year. I know how many active grants are going to be by the end of the year. Multiply the two things together, make some estimates about the pace of the new. It all falls down, right? Like this is not, obviously this isn't the entire thing. Like this is happening in pharmaceutical companies. It's happening globally. This is a US-centric data set that's informing me, but it's indicative of the global demand for, for the product. If you go to EV to sales as a multiple, right? So this is unprofitable. They have $300 million in cash, but they're losing money. It's about a $5-6 billion cap right now. If you're down towards the lower end of my sales estimate, so Street's at around that 680 mark in the middle, stock's trading around 40, 45, 50, somewhere in that range. This could get cut in half. Tools companies with a limited TAM, right? So we're talking about selling only to research scientists. Those exit, right? Those broken names exit at one-time sales, right? These are not names that sustain what I think is the very low end of expectations of, hey, this is a growth company. We're going to return to mid-teens growth in 24, 25. Let's buy that at 8 times EV to sales. That's sort of your bogey. I think if it breaks to 7, look out below. Like this is going to it's going to be a fast move from 7 to 6 to 5 to 4 to 3 to 2. And you get untethered from that growth mandate, you're going to be, sort of in that lower single digit. So 4, if it's 4, it's 1, right? So that's my view.
That's and only somebody who's followed the go-go spot in healthcare understands that, right? I mean, there's always somebody said this to me an institutional account said this to me the other day. He said, well, the problem with that, and he was talking about software, a certain segment of cybersecurity after Palo Alto blew up. He said, well, the problem with that, with cybersecurity, is that somebody's always coming in with, well, first of all, there's a new virus and there's a new solution, so you become obsolete. So it's the same thing with these biotech or these fancy-sounding names that get a lot of market cap, and they have a fancy shareholder list.
Sure.
Right. I mean, they got ARK in there, Bailey Gifford in there. I mean, evidently I don't know if ARK still believes this, but there's a point in believing something that doesn't make money, and then there's a forcing of having to believe reality. And that's what you're saying, where your multiple goes from moon, because it really is. I mean, it's a moon multiple.
Right.
To no multiple.
If this was something that became a diagnostic test, one test, and then one test became 1,000 tests. So if you look at Illumina,
scaled,
it could scale. It has future. It's essentially the software of all these diagnostic tests out there in the future, or it's the intellectual property. 10x is a box that has super cool microfluidics and allows you to essentially mass produce very, very tiny volumes and produce experimental results at scale.
You used to be long it for that reason.
Yeah, we loved it. Well, when it blew up in 2020, labs closed down. This is like I said, it's the greatest thing since sliced bread. I knew the science knew they were going to come back, so we were long for about a year and a half. And then as it topped, and you got bearish at the end of 21, I was looking at the grant data. I was like, wait, why isn't this accelerating?
Yeah.
And it was at that point that we started doing more calls, ran the model out. Then they pre-announced. But now we're just the situation I was short for a year ago is actually worse this year.
Yeah.
Right. So it's in a sense it's even at it's a much better short at this price versus when it was at this price.
Well,
the last
this
time.
is where people who have not been professional short sellers, you and I have done it for almost 25 years together. It's like embarrassing how long we've done it. We've seen we've made every mistake. We've seen every mistake. If you add up all of our mistakes, it would be doubly embarrassing, or maybe go all non-linear on us. But one thing that people routinely screw up is that they think that they missed the short.
Yeah.
This stock has gone from $150 to 46. But it's still bearish trend. So that's my risk management exercise. If it were to get above 50, well, then it'd be tougher to risk manage, because now I got a broader breakout in small cap stocks, and if they deliver on the fundamentals. If not, it fails at 50, it's just inside of 50 is trend. I mean, I just as soon as do what the CEO does. The guy sells stock like it's his job. I mean, it's incredible how much stock this guy sells.
Well, the other side of that too is if you looked at the estimate template that I have there, I'm essentially in line for Q1. They talked down Q1 really hard in the first half. They're like, well, we pulled forward a lot of demand, we had a new product, blah, blah, blah. So the first half, risk management wise, I would say your catalyst really is more about Q3 in the back half. So the back half has this massive step up, which implies the 16% growth, from 10 to 16 into next year. I think it's down on a year-over-year. I think 600 million is in the area code of correct. So they got some revisions to do into the second half.
It'd be just a disaster.
That would be a disaster. Yeah, and then again, like 4 is going to look. Well, if I can get 4, I'm taking it. Right?
Well, I'll look at this factor, but another key to a stock getting cut in half twice after it's already been cut in half twice is for Vanguard or a passive to be forced to sell based on market cap. Right. So it still has $6 billion in cap.
Yeah, has a lot. That's a lot of money.
Now, if it goes to $3 billion in cap, it may not fit the profile of being able to be in that Vanguard fund.
And when things cycle up, right? Like once you become untethered to that 7-8 number on the upside. Well, if you're going to pay 15 times sales, well, let's pay 30.
Yeah, it doesn't matter.
And once you get it, so the demarcation, or the thin red line, I think, is 7-8.
Yeah.
And once you break to 6, then you're in trouble because you're no longer. Everybody's like, well, we all agree now it's not a growth stock.
Yeah.
Well, what's the right multiple? Well, what's the cash flow?
I mean, this is I love these names. When the analyst goes from long, and we would say that when we're long, it was like, well, if it trades at 10 times sales, why not 20? As long as it's bullish trade, bullish trend, and they're delivering some narrative that people are willing to believe with some data to support it, then you'll do it. Now it's just the opposite. So good. I appreciate it. I didn't want to go through 6 ideas without having a short. So thanks. So thanks for reiterating the short. Risk management is the idea on that. And by the way, don't forget, just like the CEO of TXG, Wall Street is in the business of what? Selling you stock. Okay? That's how they get paid. Don't forget. All right, let's go. We got the rookie. He's not a rookie at Hedgeye, but and it's actually not rookie on the pitch, Nick. It's correct me if I'm wrong, because you pitched a pod stock that went moon, right?
Oh yeah, I pitched a $400 million market cap cannabis company on the long side, and today I'm pitching an $88 billion market cap software company on the short side.
So this is the kind of flexibility we want on our team. We want an analyst who can go from one team to another team. We've redone and rebuilt our tech team, so obviously now we got some juice on the software side. I think I can guess what the ticker is, but I'm not allowed to do that, so fire away.
Yeah, I'm going to pitch ServiceNow on the short side today, and we actually, me, Felix, and Andrew, which is our new software team, did a 170-page presentation on this name in January. And the duration of this call is important, as we see this being an underperformer in the second half of 2024 and into 2025. And so some of the key points are, first off, the company has seen recent success in upselling and cross-selling their workflows, which was primarily driven by the digital transformation movement starting in 2020. But this tailwind is now behind them, and it'll be extremely hard for them to sustain this growth rate. They've already penetrated the Fortune 500 companies. And in our channel checks, concerns about the platform's high costs and inefficiencies actually suggest diminished returns on investment. And so the era of increased IT budget during the pandemic is over. The next point I want to go touch on is a large growth area for the company in recent years was the government sector. And the company has already seen a majority of the cabinet level organizations standardized with ServiceNow. So the company actually saw a burst of activity with major deals signed once the budget was passed, notably the VA, which had a significant increase renewal, making for tough comps in Q3 and Q4 of this year. So these tough comps will be a serious headwind to the company. My third point here is that they've been extremely aggressive in raising prices over the years, including 20 to 30% price increase for its Pro SKU and 10 to 30% ACV lift for its Impact program rollout. And despite these increases and the 10% benefit from more standardized seats, we are skeptical of how much more price the company can take moving forward. And Keith, this has been all over all of software and all over the world, but AI is all the hype right now. And this is where management and investors point to as what's the driver for sustaining their growth rate moving forward. The issue lies with the fact that the current functionality of these products falls short of specialized needs of technical organizations, and the company is trying to get an additional 25% ACV uplift for adding these AI features into its Pro Plus SKU, which the functionality is behind the 8-ball. And lastly, I just want to say we anticipate a significant deceleration in revenue growth for ServiceNow in the back half of the year, which we're projecting to fall to 10 to 15% from 20%. And the diminishing marginal growth opportunity, coupled with high cost of acquiring new customers, casts doubt on the robustness of the upsell channel, especially with ServiceNow's largest customers. So to sustain growth, ServiceNow will either need to significantly succeed in AI or accelerate or aggressively expand into HCM or ERP workflows. Both of these areas have intense competition and innovation challenges. So now let's get into some of the slides and the data. So quickly, I just want to highlight that their CEO is Bill McDermott, who was previously the CEO at SAP, might be one of, if not the most promotional CEOs out there. In his last earnings call, he actually said, quote, "We see no price sensitivity around AI," which is a crazy remark for any company to say, especially saying that it's just a summarization tool for them right now. And I would also ask, if there's no price sensitivity with it, why are they indicating a 50% discount for their AI features compared to the listed price? On the next slide, here we have how the compensation structure for management has changed over time. I want to flag that when Mr. McDermott became the CEO, they changed the compensation structure so they would get paid on subscription revenue. And so why did they do that? Well, it had to do with the Impact program that they rolled out, which is a professional services product that is being rolled into subscription product SKUs. And so on this side, we can see what the ITSM revenue looks like on a year-over-year basis and what it looks like if they didn't include the Impact program. And so they would have seen continued deceleration in the segment if it was not for adding the Impact program into the SKUs and in 2023. And so now that this is not a lever that they can pull, we see continued deceleration in the coming years. For this presentation, we did a ton of work on TAM. Andrew really spearheaded this, and our findings were that their core TAM opportunity is 27 billion with a total TAM opportunity of 45 billion, which is much less than the 220 billion TAM story that Mr. McDermott has been currently telling. And like I said in my opening remarks, the company has been investing in AI. They are adding it to their Pro Plus SKU, which they hope to bring in 25% uplift to ACV. The issue is they got this uplift when they came out with their Pro SKU last go around. And how did they market that Pro SKU? They marketed it by saying that they're adding on analytics and AI features into that SKU. So they're kind of using the same exact marketing pitch for Pro as they are for Pro Plus, hoping to get an additional 25% increase for it. The next slide just highlights the work we did on the government front and how we don't see much more upside for them since they are already heavily penetrated. And then finally on valuation, this slide shows how we're modeling and thinking about valuation, and it shows that you have to be convinced that the company can sustain 20% plus growth for the next 10 years to own it at its current price, which it'll be very hard for them to do, and it's something that we don't see happening. And we're actually looking for 20 to 40% downside from here. Obviously, this is a name that we're going to have to, this is going to be a name that you're going to be looking for opportunities when it's up to short, but also using your signal strengths and as a way to manage it, because it's highly owned by a lot of institutional investors out there.
Big time. It's hard not to laugh. And by the way, I'm not laughing at Bill's sunglasses. He actually has I think he's got he definitely has a medical problem, so it's not that. But, like the dude just said what he said on the conference call, and then he sold over 35,000 shares, $27 million worth of stock earlier this week.
Well, in 2021, he got an options award for $140 million and went out and spent $43 million for a house in California right on the beach with his own private boat.
You can't make it up. I mean, if you don't know that Wall Street's in the business of selling you stock, Bill McDermott isn't worth that unless you bought his stock. Okay, now what's interesting about that shareholder list, it's decked to the halls, to your point, with the Vanguard and the BlackRock, et cetera. But it really... So this one gets tough because it's about the flow of the machine, because it's going to allocate to ServiceNow because it's in all these baskets. But one of those baskets, which is, was part of somehow it got into the cyber basket yesterday, it got hammered, right? And this stock's been hammered before, by the way, just because BlackRock and Vanguard own it. I mean, from the cycle peak in 2021, Nick, as you know, it went from $701, which is a prior all-time high, the most recent one being $812. It got cut in half, right? That happened. What did Bill do when that was happening? How was his behavior?
He was just trying to sell more stock. He's always optimistic and on to the next TAM story, right? Like right now it's AI. Before it was pro, and he's talking about expanding into human capital management and things like that. And so they bite around the apple for a lot of these other segments in software, but they never fully are able to go all the way in because there are other competitors in there that are much bigger than them and they're complex systems compared to ITSM, which is their core.
Now, to risk manage this, immediate term trade broke on the Pan W move yesterday, so the whole basket got nuked. This thing, 776, it would have to recapture the flag there for the machine to like it incrementally. If it can't, then it's going to buy Microsoft and it's going to buy Amazon and it's going to buy NVIDIA because those are bullish trade and trend. This one is not for now. All right, so that's the important one. If it were to get above that, then I wait for the top end of the range. So I'll give you that, obviously, every day if you want it, meaning Nick. Trend is down at 716, which is interesting because the prior high was 701, and it's got that thing sitting above it. So this is like definitely a Moab stock, mother of all bubble stocks. There's no doubt about it, almost 90 billion in market cap. But that's how I'm going to risk manage it. Just one fundamental question related to what I said to Tom, because the institutional investor I was speaking to was a software investor. You know who he is. He said, look, what Palo Alto said is really important. They're going to essentially give a freemium model on a lot of the stuff that they do for like the next 6 months. So that's going to really hurt a lot of these software companies that need to, need to keep taking this pricing and this upside down demand that they keep talking about. Is that something that ServiceNow, do you think, will get hit by?
I think a little bit. Like we're already starting to see it a little bit with other companies like Freshworks coming in on the lower end in the SMB markets for freemium at lower scale. But really, ServiceNow is focused on those enterprise type customers, the Fortune 1000s, the Global 500s, and so those will not be freemium customers. And this is a company that has tried to get into the SMB category before and failed miserably. So I don't think they can go that route, but they'll definitely be affected in one way or another.
Okay, good to know. All right, we'll be in touch on these, and nice job. I mean, since you guys went bearish on it most recently, the stock's down 5% from there, and most people, including me, because the signal back then didn't believe that the Pan W was going to happen. That thing was down 30% yesterday. That happened. All right, these software names and these storytellers can look quite different in a hurry, as you can see. Now, Daniel, welcome. I think you're calling in on a Zoom here from CAGNY. Am I right?
Yes.
For those of you that don't know what
CAGNY
is the Consumer Analyst Group of New York. I just used ChatGPT for the second time on the pitch so that I don't sound as dumb as I usually do. But you're at the conference. You've been there for, I think, 3 or 4 days, and you're going to give us the pitch.
Yes, and I wish I could surprise you, but I don't think this is going to surprise you. I'm going to pitch you Celsius, ticker CELH.
Nice.
So on my first slide, Celsius Energy, so they sought out to invent a usage opportunity as a pre-workout energy drink, and in the process, they created a better-for-you segment of energy drinks. The brand itself has aligned itself with attributes that extend well beyond young consumers and the gym. The brand did not emphasize, these testosterone sports that Red Bull and Monster are so known for, but it's courted both sexes, making it appeal to a broader market than the established energy drink brands. Competitors are responding, but those brand associations are coming back to haunt them for that. And it works against them and it works for Celsius. And I see this niche being a significant portion of energy drinks in the future as new consumers adopt energy drinks. Point number 2 is the PepsiCo agreement was really a game changer for Celsius. It was both a distribution agreement and an investment stake, making Pepsi, incentivized in Celsius growth. On my next slide, 46, I just want to explain a little to you about what Celsius is as a better-for-you energy drink. It doesn't have sugar, artificial preservatives, or artificial flavors. It touts being clinically proven to improve metabolism and burn fat. and each can contains 200 milligrams of caffeine. That's the equivalent of like 7 Cokes or 2 cups of coffee in one little skinny can, and only 10 calories. And their caffeine sources aren't more than just coffee beans, right? So it's not a coffee flavored drink. And on slide 47, you can see that there are a lot more day part occasions for energy drinks than there is for coffee. Coffee tends to be just really consumed in the morning, where energy drinks have sort of a long window. So if you've been using Celsius to, before your workout to maximize your workout, well, it's not a stretch to, take it before you're studying for your midterms or studying for your tests, right? And so you can be drinking it late at night. And on slide 48 is the sort of the details of the PepsiCo agreement. This really was the game changer. Pepsi put in $550 million, and they plugged Celsius into their distribution network. And that was what was so important, right? All of a sudden, overnight, you saw Celsius into almost all the doors that PepsiCo distributes its own products in. We've now anniversaried that sort of door growth explosion, and that's really what held the stock back in the last couple of months. As they got close to that anniversary date, and they had sales growth over 100% as a result of all those doors being open for them. But now we're getting into the additional growth drivers. So, and some of these can be more meaningful than just opening up the door. So right now, the latest data and scanner data in the month of January, Celsius is growing 77% on top of triple-digit growth last year. So you can see what I mean by other drivers of sales being, maybe even more important. On the next slide, you can see, this I think speaks to itself. When I tell you that, Celsius is a wide distribution, wide customer base, wide usage, this says it all, right? So Celsius is selling through such a wide spectrum of retailers. You can find them in natural stores. You can find them in grocery stores, at the gym, right? You would never see Monster at your gym, right? You're never going to see someone, lifting heavy weights and drinking Monster. You're just as well, you're not going to see someone buying Red Bull at GNC, right? But you can see Celsius at all these places. And Celsius is actually expanding in the restaurant channel right now as well. So I think this really speaks to big, wide use of, for the energy drink, as well as who the customer is. And then on the next page, I took these photos myself, that's why they're not that great, but this shows you what the growth drivers are this year as the anniversary opening the door. So Pepsi got Celsius into all the doors. This year the growth is from cooler installations, displays, further shelf space gains, compelling promotions, and that's what you see here. These pictures are from a 7-Eleven. People don't go to 7-Eleven to buy, stock up on several drinks, right? They're not grocery shopping. They're just meeting their thirst needs. But here you have this very effective promotion, 3 Celsius cans for $6. It creates that value. But the fact that this thing was, did so well for them speaks to, people sensing, what a great deal that was, and you can create a lot of sales that way. You're selling 3 units, right? So that's your unit growth for this year. And then on my final slide, international growth, I had to mention F1, Keith, because I think we talked about this earlier today, F1 and Celsius. So Celsius is just getting into international markets, right? So they just launched this quarter into Canada. They weren't ever sold there before legally. And the company also announced an agreement with Suntory to distribute it in the UK. So that's going to be the first market across the pond. Celsius also formed a sponsorship agreement just recently with Ferrari, and it's going to be their exclusive energy drink. And as you know, energy drinks and F1 go hand in hand, right? Monster and Red Bull even owns a team, right? So that they're very famous in the energy drinks that you have. There may be an exciting team here next year with Ferrari. And that's not a cheap promotion, but the fact that they're doing that speaks to their global ambitions, which aren't even in the numbers, right? So to sum up, energy drinks are one of the fastest growing categories in food and beverage. Celsius is appealing to both young and female consumers, so it's growing the energy drink market, and we're just starting the international expansion. We're at day 1 right now.
Well, Mr. Leclerc, as they'd say en français, is a good-looking young guy, and he's the guy who's chasing Verstappen a lot. So you got the Red Bull against the Celsius. I like that. I like that quite a bit. You have this is talk about chasing. I'll give you a little history. It's kind of embarrassing, but back I think it was in like 04 at least through 05 or 06. I'd always short Monster, right? MNST. Now, you can look at a long-term chart of Monster and you can see how dumb I was in doing that, but this is why I did it. Because I was a really smart guy who went to Yale that knew Monster was expensive. You know, and I had a model that says it was expensive, and my boss didn't like expensive stocks. So we'd short it, and we'd get our face ripped off all the time. And it's like, you watch this same thing with Celsius. I mean, Celsius, if you actually have a long-term view, and it only has $14 billion in cap. At this point, as most of you should know, I think Monster has about $60 billion in market cap. So is that the biggest pushback, and is that why the short interest is almost 30% of the float?
Yes, it's the deceleration of sales, and I think you saw that before the even anniversary that I think hit the stock, but you've seen them way outpacing where the expectations are. I think the official estimates, consensus estimates, are around like 35-40% growth. I just told you the scanner data was at like almost 80%, and I think that's a big part of it. People are trying to bottom ticket. I will tell you, Monster, I think, was the best performing stock of the last 20 years. I think you probably have to remove it, NVIDIA, if you did that in the last couple of days or anything, but I think it was the best performing stock of the last 20 years. And Celsius is not going to have to just take it from it. It's going to grow the market. And I think it shows you that it's done before, and they're going to do it with a female audience, so it can be twice as large.
Now, on the a quick question, because I'm going to get to Billy Z here in a second. How about DeSantis? We're not talking about the DeSantis that you might think I'm talking about, but Carl DeSantis, he came from, I think, Rexall. Do you like him? Do you trust him? Do people not like him, not trust him? Where are we at on that? He owns 12% of the float, by the way, still.
Yes, and so, I think people get hung up on who the older investors are. There's some, people who invested in it when they had no idea this would happen. Sometimes it's good to be a little lucky. And I think, if you look at the early days of any of these big companies, right? Like look at Lululemon and meet their founder, right? Like, sometimes something can take off a lot more than anyone expects. And I think that's generally the case for most of these consumer things. If you were too knowledgeable about their early days, right? Like even if you spent time with, name any tech pioneer, right? Like what they look now compared to what they were then, I don't think you can spend too much about, the people who got a little lucky. You just have to look at what the brand is now.
I mean, the brand now is white hot. I mean, you can see it, and especially if you're me or older, you wouldn't get it like the next generation does, obviously. But here's another note for those of you that are aspiring short sellers, like that screwed everything up like I have with Monster or did. I don't anymore because I have Biolsi. But use the trade and trend levels, okay? So this one is bullish trade, bullish trend. For a bear to start to get paid, you'd have to break at least a medium-term trade momentum of 57. Stock's at 64, so that doesn't look likely. And by the way, trend is well below that at 54. So this thing's been a beast. In our own internal competition, you're winning the race having picked this car. Pardon the pun with F1, but we have a new product coming out that is called Stock Picks. We're simulating F1 a little bit. I'm just teasing you guys just as I would, but thank you for that, Biolsi, and get back to doing your work. Appreciate it. From the CAGNY conference, that is Billy Z, man. You get, like, Friedman's like, okay, take the puck.
Yeah, give me the chance here. I'm not known for my breakaway abilities, but this is a little bit different. So hopefully I do a good job.
Is this your first time on the pitch?
First time.
I think it is, because I'm realizing how much taller you are than me.
I'm wearing like 3 inches on my shoes here.
I like that. I like
that. No, thanks for having me on today. I really appreciate the opportunity, Keith. I'm going to be pitching one of our top longs, TKO Group Holdings, ticker TKO. You actually sent the buy signal out on it yesterday, and we discussed the name on the call for the past couple of days. And it's not a stock that we want to hold on a quarter-to-quarter basis. It's more of a long-term one for us. We believe the stock has, over 30% more upside to go from here, given where it's trading around $86 right now. Just on the key points of debate here, I'm going to be focusing more on WWE, but I just wanted to hit on UFC really quickly because it is a very important part of the business. What matters for the UFC is that it's a very high margin business. Around 60% EBITDA margins. It's got global scale and a proven revenue model that's based around pay-per-view events on broadcast and streaming TV, which is not only valuable to TKO, but also to the broadcast and streaming partners who get the benefits of subscriber acquisition and retention from that. And the demand for combat sports is also on the rise. MMA fans are growing, ratings have gotten better, viewership has gotten better, and the format of the sport actually plays in really well to sports betting, which in 2023 had a record year. On the WWE side, the bull case that we see is already kind of coming to fruition. We've got an established brand here with 2 long-term media deals locked into place over the past 4 months. The Raw revival is underway with Netflix stepping in here, helping the brand front run the rest of the sports industry, going completely direct to consumer and expanding their audience internationally, which is very significant for them as they've been a predominantly American and to some part Canadian business. And Vince McMahon is finally out the door here with his exit as executive chairman and the lawsuits, which will should allow Endeavor, Endeavor and their suite of media sports professionals to get in here and help improve the revenue base, sign more rights deals, get more sponsorships for the company, increase their advertising and more. And on the next slide here on the viewership trends, you can see this upswing in the WWE business, most clearly in their viewership numbers, which largely determine the value of their media rights, and they've consistently outperformed pay television channels for the last half decade here. Raw viewership has surged over the last year. SmackDown has outperformed even the top 4 broadcast channels during this run on Fox. And I think these trends really just speak to the increasing popularity of wrestling and by extension, the value it holds. On the next slide, you can see the industry at large. Sports rights just keep on increasing at the same time. Across the entire landscape, the average step up in sports rights in the last decade was about 1.86 times, with the NFL, NBA, NHL, UFC, and F1 all coming in above that average. Media companies need sports to draw in subscribers and continue to prove that they're willing to pony up a lot of money for these rights. Point in case, today we had news that Amazon is going to be paying $150 million to stream one NFL playoff game on Amazon Prime Video next year, which is a 25% premium to what Comcast paid to have a playoff game on Peacock this year. So rights are very valuable. Sports are moving to streaming. Everyone's going to try to get a piece here, and that's kind of what we're seeing happen in the industry at large. On a cost per viewing hour basis, Raw and SmackDown have historically been under-monetized compared to similar properties, considering their strong viewership. Audience growth is essential here for commanding a premium value in the rights, and Raw's increased reach on Netflix should signal its potential for a higher valuation in the future as well. UFC maintains an even more valuable position because not only does it have strong viewership, it's way more scarce in terms of the amount of events that you get every year. So this kind of strengthens TKO's hand in the future as they go into negotiations with ESPN, and I would assume also Disney and Fox, given the new streaming sports joint venture. And it could imply, significant potential upside for TKO on this UFC renewal in a few years. The next slide on the contenders, just wanted to point out that we did have Netflix in there as a dark horse back when we made this pitch in December. And the thinking there is very similar to why we had Amazon on this list. They could pay a higher premium just based on their user base. International reach was part of that, and just a part of a larger strategy for these guys to move into sports in general and get more sports content on their platforms, which Netflix is definitely trying to do, despite some narratives out there that they're just trying to do sports adjacent stuff. On the next slide, just a visual depiction of the WWE rights renewals over the years. So this is what the revenue stream for WWE will look like after this new renewal. Keep in mind the Netflix deal is a 10-year contract that can be renewed when that's up. At the same time, the company's going to have to renegotiate the WWE network with Comcast in 25 and 26, and then they'll have to sign a new SmackDown deal, which I would imagine would be with a streamer in 5 years after this current one they just signed expires. And just to wrap this all up with our valuation and scenario analysis, working all these numbers through our model, very dependent on the step up that we got in WWE Raw. We come out to a stock price of about $112 based on the 2025 numbers, which again is a just over 30% increase to where it is trading today. So,
what's interesting is that its all-time high was $111. So you're just, and it's atypical that a stock can, well, first of all, it's signaling what we call phase transition. So the stock blew up after doing well. Mm-hmm. Interestingly, it did well during 2022 when most stocks were blowing up. So it proved to be like counter-recessionary, so to speak. But bullish trade, bullish trend, $82 is trend. So that's starting to break out on news, right? So the post company with Netflix has to be worth more than the pre.
Yes.
And so why would, Like if people were willing to pay 111 last time, we're at 112. So maybe I would say that's probably conservative.
Yeah, I think the problem with why it blew up on the first news when that SmackDown deal got signed, it was a 1.4 times step up, where the street was a little bit higher on that.
Okay.
So when that deal came in lower than what people were expecting, questions about terminal value came into play, questions about what Raw was going to get in the market came into play, and it kind of just compounded on itself. But now we got the Raw deal came in. It was with Netflix, a very strong brand partner with a lot of international reach.
Yep.
The step up when you break out all the other numbers, because they also got international rights to SmackDown, and they also got a few other things included in that. The actual Raw value is much closer to what the street was expecting, but just it was a big sigh of relief almost. Like, okay, it's on Netflix, it's going to be good for 10 years. It's a very steady revenue stream. We like the deal. It kind of put a lot of the fears that the market had after that SmackDown deal to bed. So that was the reason why it went down so far, was off of that, the long-term perception of the value of the stock after that SmackDown deal.
You had that. I mean, that was definitely a SmackDown it got to $90 that day. I mean, and then you had the Vince McMahon news, right?
Yeah.
I mean, so which anybody who knows anything about that probably knew something, right? I mean, but at the same, I shouldn't say at the same time. What's interesting, I was just doing my screens, and I love doing this with you guys because this is like my old boss used to do this to me. John Dawson be like, well, what about this insider sale? What about this insider buy? What about this short interest? This thing has a lot of short interest, so bears are there. But you do have both this guy Ariel Emanuel and Mark Shapiro buying stock before the new year, but they're buying stock and McMahon's selling stock. Right. So at least we got like a good horse race going on there.
Yeah. So a lot of that, and there is a downside to this, because what the bears will say is that this deal, WWE being sold to TKO or Endeavor rather, is a liquidity event for McMahon, who has a lot of money tied up in WWE stock.
Yeah, he owns 11% of the stock still.
Yeah, so he's a lot tied up there. He can sell it whenever he wants. There was no holding period after that deal was signed, and now he's out as executive chairman. So there's always a risk of he's just going to unload all those shares onto the market. But I would say on the other side of that, you do have Ari Emanuel and Mark Shapiro buying back that stock. And at the same time, with McMahon out of the picture, he did a great job building the company up. He was the life of WWE for 30 years. But he's getting older. He made a lot of mistakes. His personal issues, the legal issues, all is a drain on the company. It's not great. So now that he's out of the picture, it really allows these two guys, Ari and Mark Shapiro, who did a very good job building out Endeavor, a very good job with the UFC, to come in here, get their guys in there, reinvigorate the business, and kind of hit a reset on the leadership and the public perception of it, and just kind of run with it. And at the same time, they're buying back stock as well. So
the companies.
The company is. So,
do you know how big their buyback is? I didn't see that.
I don't have the authorization off the top of my head. I was referring to Ari and Mark.
Yeah, buying insider buys. Yeah,
Yes, insider buys.
It's the only stock actually of all the stocks that were pitched that has insider buying by the executives, and that's generally Wall Street's in the business of selling you stock. But this is the point: you have a founder who is past his prime, suffice to say, and has more issues than Time Magazine, and the guy's he's selling you stock, but the new team's buying the stock, which is great. It's really good. I did not know that till I was forced to sit here and go through some screens while you were talking. So thank you for that.
Absolutely.
And thanks to all the analysts for the pitch. Again, if you're not constantly learning, and that's the beauty of this game. I love this game, if you can't tell. Every single day, throughout the day, you can learn something new. In fact, you can learn a lot that's new. If you have the ability to pay attention, deliberately study what's going on, have a process to backstop it. These stocks aren't just about stories. We're going through a lot of different things embedded in the process. The pods, revenue growth rate, is it accelerating or decelerating? Pod 2, cash flow. Pod 3, McGough said, balance sheet. There's a lot that goes into a good idea. It's a really hard thing to get right, but we're very confident, I would say, that we're going to get more right than we're wrong, and I just have to thank my analysts for doing all the hard work on that. Thanks for joining the pitch.